In 2019, WeWork boasted a staggering valuation of $47 billion. 4 years later, the company filed for Chapter 11 bankruptcy protection. Excessive spending and governance issues plagued its rapid rise and fall. What led to this dramatic collapse from a multi-billion-dollar valuation to financial ruin? WeWork emerged in 2010 as a disruptive force in the real estate sector. By 2014, it had become the fastest-growing lessee of new office space in New York. The company attracted significant investment from SoftBank, which agreed to a $4.4 billion infusion in 2017. At its peak, WeWork was valued at $47 billion, a figure that underscored its ambitious growth trajectory. However, the company's financial health was precarious. In the first 9 months of 2018, WeWork reported losses amounting to $1.2 billion, despite generating $1.5 billion in sales. The excessive spending by CEO Adam Neumann and governance issues soon drew criticism. This was compounded by the cancellation of its IPO in 2019, which was initially set to solidify its financial standing. SoftBank, a crucial investor, initially planned a $16 billion investment but scaled back to $2 billion. This decision reflected growing investor skepticism. SoftBank's total investment in WeWork eventually reached $10 billion, but the financial strain was evident. The company recorded over $2 billion in losses in 2018 alone. The COVID-19 pandemic further exacerbated WeWork's challenges. The demand for shared office spaces plummeted as remote work became the norm. By 2023, WeWork's valuation had collapsed to $8 billion, a stark contrast to its earlier highs. The company filed for Chapter 11 bankruptcy protection in November 2023, marking a significant shift in its fortunes. The decline was marked by layoffs, including 2,400 employees in late 2019, and a restructuring plan that involved breaking 69 leases, with 41 in New York City. WeWork's rise can be traced back to its founding in 2010, when it positioned itself as a pioneer in the co-working space sector. The company capitalized on a growing demand for flexible office solutions, appealing to startups, freelancers, and small businesses. By 2014, WeWork had become the fastest-growing lessee of new office space in New York, a testament to its innovative business model. The company's momentum attracted significant attention from investors. In 2017, SoftBank made a bold move with a $4.4 billion investment through its Vision Fund, further accelerating WeWork's expansion. This infusion of capital allowed WeWork to broaden its global footprint, establishing a presence in key international markets. The strategic partnership with SoftBank was pivotal, as it provided not only financial backing, but also credibility in the eyes of other potential investors. WeWork's valuation soared to $47 billion, reflecting the market's optimism about its growth potential. This valuation was supported by WeWork's aggressive expansion strategy, which included acquiring complementary businesses. In September 2018, WeWork acquired Team for $100 million, bolstering its technological capabilities and enhancing its service offerings. The company's financial performance during this period was marked by impressive revenue growth. In the first 9 months of 2018, WeWork's sales reached $1.5 billion, demonstrating its ability to generate substantial income. However, this growth was accompanied by significant losses, totaling $1.2 billion during the same period. Despite these losses, the market remained bullish on WeWork's long-term prospects. WeWork's business model was seen as revolutionary, offering a unique blend of community, flexibility, and design. This model resonated with a new generation of workers who valued collaboration and adaptability. WeWork's spaces were not just offices, they were vibrant communities that fostered networking and innovation. The company's rapid expansion was fueled by its ability to secure large-scale investments. In January 2019, WeWork raised an additional $2 billion from SoftBank, reinforcing its position as a leading player in the co-working space industry. This financial backing enabled WeWork to pursue ambitious projects and continue its aggressive growth strategy. WeWork's rise was also characterized by its cultural impact. The brand became synonymous with the future of work, appealing to a demographic that prioritized work-life balance and creativity. This cultural resonance was a key factor in its ability to attract and retain members, further driving its expansion. Despite the challenges that lay ahead, WeWork's rise to a $47 billion valuation was a remarkable achievement. It highlighted the company's ability to capitalize on market trends and investor enthusiasm, setting the stage for its eventual public offering ambitions. The turning point for WeWork came in 2019, when the company's trajectory shifted dramatically. In August of that year, WeWork filed Form S-1 in preparation for an initial public offering, or IPO. This move was intended to solidify its market position and provide liquidity to its investors. However, the IPO filing exposed significant financial and governance issues within the company, sparking widespread scrutiny. The details revealed in the S-1 filing were concerning. It highlighted WeWork's mounting losses, alongside CEO Adam Neumann's extravagant spending and questionable management practices. These revelations raised red flags among investors and analysts, casting doubt on the sustainability of WeWork's business model. Concerns about corporate governance and financial transparency became central to the narrative surrounding WeWork. As a result, investor confidence waned. SoftBank, a major backer, altered its investment plans drastically. Originally intending to inject $16 billion into WeWork, SoftBank reduced its commitment to $2 billion. This decision signaled a loss of faith in WeWork's ability to achieve its previously projected growth and profitability. The planned IPO was subsequently canceled, marking a critical juncture in WeWork's history. In the wake of the canceled IPO, Adam Neumann resigned as CEO. His departure was a significant development, as Neumann had been the face of WeWork and a driving force behind its rapid expansion. The leadership change aimed to stabilize the company and restore investor trust. However, the damage to WeWork's reputation and valuation was already done. Following these events, WeWork's valuation plummeted from its peak of $47 billion to $8 billion. This dramatic fall reflected the market's reassessment of WeWork's true value, given its financial instability and leadership challenges. The company faced intense pressure to restructure and cut costs, leading to the layoff of 2,400 employees in November 2019. The turning point in 2019 set off a chain reaction of consequences. WeWork's ambitious growth strategy was curtailed, and its business model was scrutinized more than ever before. The once promising startup, hailed as a pioneer in the co-working industry, found itself grappling with the harsh realities of financial mismanagement and governance failures. The events of 2019 were pivotal in altering WeWork's trajectory, ultimately leading to its bankruptcy filing in 2023. In November 2023, WeWork filed for Chapter 11 bankruptcy protection in the U.S. Bankruptcy Court in New Jersey. This marked the culmination of a series of financial and operational setbacks. The bankruptcy filing was accompanied by plans to break 69 leases, including 41 in New York City. This decision was part of a broader strategy to shrink operations and cut costs. The fallout from WeWork's financial troubles was significant. The company's valuation, once at a peak of $47 billion, had dropped dramatically to $10 billion. The collapse in valuation was a stark reflection of the market's reassessment of WeWork's business viability. The company faced the challenge of restructuring its operations and finding a path to financial stability. In 2024, as part of the bankruptcy reorganization, Cooper Grimond acquired a 60% stake in WeWork. This acquisition was part of a broader strategy to stabilize the company and chart a new course forward. SoftBank, which had been a major investor, also retained a stake in the restructured company. The financial consequences extended beyond WeWork itself. SoftBank, a major backer of WeWork, tallied up write-downs totaling $9.2 billion on its investments, following the startup's failed IPO. This write-down represented a 90% reduction in the value of its investment, underscoring the financial impact of WeWork's decline. The consequences were not limited to financial metrics alone. The company announced layoffs of 2,400 employees in November 2019. This move was part of a broader effort to reduce costs and streamline operations in the face of mounting financial pressures. In addition to layoffs, the company took steps to amend leases and sell all owned real estate. These actions were part of a strategy to realign WeWork's business model with its new financial realities. The restructuring aimed to create a more sustainable business model focused on profitability rather than rapid expansion. The aftermath of WeWork's decline serves as a cautionary tale in the business world. It highlights the risks associated with aggressive expansion and the importance of sound corporate governance. The company's journey from a $47 billion valuation to bankruptcy underscores the volatile nature of the startup ecosystem. WeWork's dramatic rise and fall is emblematic of broader lessons in the business landscape. The company's trajectory underscores the critical importance of sustainable growth and prudent financial management. At its core, WeWork's decline was precipitated by governance issues and unchecked ambition. These factors serve as a stark reminder of the potential pitfalls when business fundamentals are overshadowed by rapid expansion. The repercussions of WeWork's financial missteps extended beyond the company itself. SoftBank, a significant investor, faced substantial write-downs, illustrating the ripple effects of corporate governance failures. This scenario highlights the interconnected nature of modern investment portfolios and the potential vulnerabilities therein. Investors and stakeholders must remain vigilant, ensuring that due diligence and risk assessment guide their decisions. The fallout from WeWork's bankruptcy also underscores the importance of adaptability in business. The company's need to restructure, amend leases, and sell real estate assets illustrates the necessity of aligning business models with market realities. This adaptability is crucial in an ever-evolving economic environment, where external factors such as market sentiment and global disruptions can significantly impact business viability. In essence, WeWork's story is a powerful case study. It emphasizes the need for balance between innovation and financial discipline. It serves as a reminder that visionary ideas must be grounded in practical execution to achieve long-term success. The decline of WeWork from a $47 billion valuation to bankruptcy was a complex interplay of factors. Corporate governance issues and excessive spending were central to its downfall. The canceled IPO and the COVID-19 pandemic further exacerbated its financial woes. WeWork's story is a stark lesson in the importance of sustainable growth and prudent management. It underscores the volatility inherent in the startup ecosystem. The narrative of WeWork's rise and fall serves as a cautionary tale for businesses and investors alike. As the business world continues to evolve, the lessons from WeWork remain relevant. Stay informed, stay vigilant,